Hey guys, and welcome back to the Value Investor Show. Today I'm going to talk about a stock that just double beat earnings yesterday and is already up 12% after hours. So today I want to go through which stock this is, why the stock was down 50% this year, which made the valuation very attractive for me to enter. I'm going to go through the earnings call analysis, intrinsic value model, and whether I'm buying more or selling. But before we dive in, I want to thank you guys for the overwhelming support. The likes, the comments, the views, and the feedback have been amazing. If you could subscribe, it would mean a lot. I know 11% of you are subscribed. Hitting the like button and subscribe button really helps. I spend so much time putting together this content together, so any support, including following me on X for my daily updates, goes a very long way. All right, let's get right into it. So I've been talking about this stock for weeks, and the stock is the one and only Deckers Corporation. I actually posted a deep dive more than 2 weeks ago explaining why the stock has crashed 54% from its all-time high, what everyone was missing, and why Wall Street fear created a misjudged situation. Deckers own Hoka and UGG, two very powerful brands. I actually myself own Hoka's. They're my go-to running shoe. The tech around the shoe is insane, and when I saw the stock price and run the numbers, I realized there was a gap and I entered. So in terms of earning results, Deck just posted their Q1 2026 earnings and double beat expectations. The stock jumped 12% after hours, and at one point it was even 17%. My entry point was $101, so I'm already up significantly in less than a month. But what's important is understanding how we got here. Deckers has consistently beat earnings. In fact, over the last 20 quarters since 2018, they've beat estimates 18 times, only missing twice. Despite this, earlier this year, the stock took a major hit due to a few things. So investors' fear drove the stock down 50% from its all-time high, which created a massive opportunity. And the four catalysts behind this drop is firstly, tariff-related cost pressure. Deckers have a very heavy reliance on Vietnam-based sourcing, which as a result exposed them to 150 million in additional costs according to the CFO, which would essentially reduce margins. The second thing highlighted by the leadership is the slowdown in direct-to-consumer demand for Hoka. The near-term revenue growth decelerated last quarter, but partly due to weaker consumer sentiment and shifting buyer behavior. Now, the third reason was the 2026 guidance. Earlier this year, the CFO provided soft guidance of mid-teen sales growth for Hoka and mid-single digits for UGG in forward year 26, excluding potential consumer weakness. Now, I want you guys to remember this because when we go through the numbers, remember what the leadership has guided. Fourthly, there was general macro weakness highlighted by the leadership. For example, broader economic softness has led to weaker discretionary spending overall. This scared investors, but as I flagged in my previous video, I believe leadership was downplaying expectations to set up future earnings. This has caused the stock price to decrease significantly, and that's exactly what happened. They sandbagged guidance, Wall Street slashed their expectations, and Deckers came in for Q1 2026 beating estimates big. Meanwhile, they were buying stocks aggressively through the whole time. So let's get right into Q1 breakdown. So Deck's Q1 results were excellent. Hoka and UGG outperformed their first quarter expectations with robust growth, delivering solid results for fiscal year 26, said the CEO. Though uncertainty remains elevated in the global trade environment, our confidence in our brand has not changed, and the long-term opportunities ahead are significant. We will lean on fundamental strengths of our powerful operating model as we continue executing our strategy. Hoka brand sales are up 20%, UGG sales are up 19%, and other brands decrease 19%, but other brands are very insignificant compared to Hoka and UGG. The biggest surprise for me is UGG. I didn't expect a 19% growth for a seasonal winter brand in this quarter, and I think that shows a big statement. Also, as we said, Hoka sales were expected to rise at mid-teens, so that's like roughly 12 to 13%, but they actually grew 20% year on year. Now, another thing that was flagged by leadership was that direct-to-consumer sales are seeing a slowdown, which we are seeing right here. So direct-to-consumer net sales increased 0.5% and comparable net sales decreased 2.2%. So that was something that we expected, but I think it just reflects a shift in how consumers are buying. As you see, guys, wholesale net sales increased 27%, which has really offset any kind of, drop or stagnation in D2C. Now, gross margin fell slightly, but operating income and diluted EPS increased. Cash and cash equivalents also hit 1.7 billion on a 15 billion market cap company. But one of the best things about this company is that it has zero debt. It also has a 2.5 share buyback. And I'll tell you guys, it's so rare to find a company that is growing like this, has no debt, has such a clean balance sheet. I bet you will not be able to find more than 3 companies that are growing at this rate with zero debt. Now, in terms of brand performance, Hoka is a beast by itself. Since 2019, the brand has grown 8 times in revenue on a quarterly basis. I'll say that again. It has grown 8 times in revenue. So it's generating 8 times more revenue than it did 6 years ago. Tell me that's not insane growth. I think, in my opinion, the valuation is justifying just Hoka without UGG. And UGG is growing at 18% year on year. So in my eyes, this is insane growth. This is a very attractive company, and I don't see how it will slow down anytime soon. Now, looking at the balance sheet, looking at the income statements, firstly at the balance sheets, assets are growing, liabilities are shrinking. Now, on the income side, net sales are increasing, comprehensive income is growing, and margins are holding very strong. This is a 14 to 15% profit margin company. I mean, if you compare that to Nike, which is 6%, I mean, there is no direct comparable. And they're also buying back shares very aggressively. Now, I listened to the entire 40 to 50 minute earnings call so that you guys don't have to. And I want to flag you guys through the 5 key points that I have noted down. Firstly, growth. The CEO said that they will see more improvement in growth, especially in international growth, and I think it's something that is also reflected in the current quarter. The second, around tariff impact, they said that the tariffs have been mitigated in the US for now because they have used inventory that was already on land before tariffs, and they also hiked up prices for some of their brands, some of their products that have also mitigated that tariff impact. In terms of 2026 guidance, the leadership was still a bit cautious to provide estimates on what that could look like, but they said they want to see how the consumer will react as tariffs materialize. And they also said they talked about their localization strategy. That means that they're investing in region-specific marketing and community building, which I think is great, especially in the running community. And finally, in terms of competition, they said they will continue to invest in brands. They have a very strong balance sheet which allows them to keep investing while peers might not be able to do so in the fact that Deckers can. Now, in terms of the financial analysis and valuation, Deck has performed exceptionally well over the past years. Revenue, net income, EPS, and free cash flow growth has been just insane. This is a consumer brand. This is a brand that creates shoes. I mean, these numbers, you probably see them and think it's Palantir or, I don't know, a tech company, but it's a shoe company. So in my eyes, this is an exceptionally well-run company. In the last 3 years, the average P ratio was 23. It's now currently trading at around 17 in terms of P ratio, and that makes it exceptionally attractive. The profit margins are excellent. The profit margin has been increasing as well. It's now currently at 14 to 15%. And as I said, the company is buying back shares aggressively. Now, the return of assets, equity, and invested capital is also extremely attractive. It's much better than many other consumer brands, and in terms of debt, they have zero debt. Now, this takes me to the valuation. Now, as we said, the company is now trading at the 17 P ratio. I used an 8% discount rate. I know some of you might say this is low, but remember, the discount rate is essentially your WACC. The company has no debt, so that means we can use a lower discount rate. We don't have to use a 12% discount rate, which we would use for higher debted or higher leveraged companies. I also use a margin of safety of 50%, and I have been relatively very conservative with my revenue, EPS, and FCF growth estimates. I prefer to remain on high single digit or low double digit growth estimates just because I wanted to have a more conservative view view, even though Q1 estimates have been much more attractive. As the leadership have said, tariffs could create more problems in the next quarter, so I prefer to remain more conservative myself. And even with that conservative estimate, that gave me an average intrinsic value estimate with margin of safety of 50% of $109 per share. And that positions my price target to 250 with $300 per share by 2030, which is why I think the stock price will triple by 2030, at least the price that I have entered, which is 101. I think it will triple by 2030. So am I buying or am I selling? Well, the answer is I'm holding. I'm extremely happy with my current position. I have a significant position in DAC and I'm extremely happy of how earnings have turned out. I'm long on the stock, and if it drops below the intrinsic value with margin of safety, I'll definitely buy more, but I doubt it will given such strong result. My view is that we will see analysts raising their 12-month price targets for DEC in the coming weeks, which will boost the stock further. Now, I want to thank you guys again for watching. If you would like to support me, you can buy me a coffee using the link in the description. I put so many hours to this content. Any donation, no matter how small, would mean a lot. Please subscribe and I'll see you guys next week.